Hello friends, James Stevenson talking about Tesla's earnings on a per delivery basis. How good are they? Are they getting better? Are they getting worse? What's going on? Do you believe the Tesla haters, the short sellers, and the trolls telling you that Tesla doesn't make any money anymore? Or that demand has fallen off a cliff, etc.? Loki has turned his back on the very idea of that argument because it's not true. I will share my desktop with you and go through tweets 8 and 9 from my most recent Tesla earnings forecast thread that I put out on Monday. Tweet 8 reads, Tesla earnings per delivery remain world-class for any automaker, let alone an EV maker. Tesla's strategic price reductions will remain a drag on earnings per delivery growth throughout 2023, but total earnings dollars will rise along with delivery volume. So let's take a look at this chart. So the peak for Tesla earnings came in Q4 of 2022 when prices were still pretty high before interest rates got real high and made payments really high for folks. Also, there's a little bit of seasonal weakness in Q1. So if you want to grow in a quarter that's seasonally weaker, you need to cut prices. So that's not a surprise for anybody who's been holding Tesla stock for a long time. Tesla probably won't be able to sell $20 million cars per year at an average selling price of $55,000 or $60,000, right? So price cuts were coming, and especially with all this profit per vehicle, as Tesla continues to drive down the cost per vehicle by getting more efficient, opening new factories that at scale ought to be more efficient than Fremont is. Tesla's cost per vehicle ought to be coming down, so Tesla can afford to cut prices a little bit more and sell higher volume, which is what we saw in Q1 and then in Q2, with earnings per delivery falling from that record high, 10,747. These are all on a trailing 12-month basis. Tesla hater who goes by the fake name Brad Munkin was thrown by that and accused me of not having accurate figures here when he just failed to read that these are trailing 12-month averages and not the actual for each quarter. So that fell some in Q1, and it fell a little more in Q2 to $8,458 worth of profit per vehicle. Again, these are numbers that GM or Ford would salivate over. The idea of making more than $5,000 per vehicle would be like, they would throw a parade in Detroit if they could average more than $5,000 worth of non-GAAP earnings per delivery. Those are unheard of numbers for them. They're making, $1,000, $2,000, $3,000 worth of profit per vehicle, if that. So where do I have this bottoming? Well, I've got it bottoming for the full year 2023 numbers at 7,798 is what I've got here for Q4 of 2023 before the curve turns the other direction. What's doing this? As I mentioned in my EBITDA chart video, it's mostly the full self-driving take rate improving. So as full self-driving gets better and more people want to buy it, that revenue per vehicle will improve. And because there's no variable cost or very little variable cost associated with that product, mostly it's a fixed cost of development for the FSD program, you get more earnings per delivery when you sell more FSD to more of the people who buy a Tesla, because that's a feature they want. If they see that the car is doing a great job driving itself without needing a lot of interventions, then they'll be likelier to buy a Tesla with full self-driving. For as long as that's available to be purchased for a one-time fee. Now, I'm not promising that Tesla will always offer full self-driving as a one-time fee you can pay and have full self-driving forever for the life of that vehicle. At some point, Tesla may decide, no, we want to make that a subscription-only product, and you'll have to pay $250 or $300 or whatever Tesla decides the subscription rate is going to be. If you want FSD, that'll be your only option, could possibly in the future. What about this other chart? What's it doing? It looks the same. It is the same, except with regulatory credit sales thrown out. That used to be a really popular thing to do back when these numbers were negative. So you see numbers in parentheses back here indicating also the fact that the bars are descending from the axis downwards tells you these were losses back here. I used to bother making those red instead of green. I stopped bothering with that because they're so long ago that Tesla was losing money if you threw out the regulatory credits, which it says up here in the title. It's the same story here, just a little bit smaller numbers, a little bit smaller positive numbers, a little bit larger negative numbers. That's what's going on there. Why won't earnings per delivery fall by more? Because Berlin and Austin, Tesla's newest two factories, are ramping up Model Y and lowering their costs per delivery. The more vehicles you make per hour, the lower the cost per vehicle produced goes. I hope that makes sense. Fremont has high labor costs because Fremont is in California, and California has wacky labor laws where you have to pay salaried people overtime, stuff like that. A lot of weird higher costs in California. Also, the Bay Area is just a very competitive labor market, so you have to pay a lot to get good people to work those jobs. Will become a smaller portion of Tesla's global sales mix. Yeah, so as Fremont-produced vehicles become a smaller and smaller portion of Tesla's revenue, that high labor cost becomes a smaller and smaller portion of Tesla's overall costs. So the more vehicles Tesla can make in Berlin and in Austin, where labor costs per vehicle are lower, again, at scale, as those factories scale up, the cost of sales gets better. The cost of sales percentage improves. It goes down, leaving more gross margin per vehicle produced, which turns into, after operating expenses and below-the-line items, earnings per delivery, which is what you see here. And I'll just show you very, very briefly from my earnings projection model what I'm talking about. Here's the line for the Berlin Model Y. So, for example, in 2022, I think Tesla was losing money on that product earlier in the year with a cost of sales percentage over 100. And then toward the end of the year, the cost of sales percent was still in the 90s, right? But as the scale ramps up, those products ought to become more profitable. So by the end of next year, I think the cost of sales on Berlin Model Ys should be down to only 70%, leaving a 30% gross margin, right? Same as Fremont. And then for Austin, it ought to be even better than that. So for the Texas Model Y line, I've got those coming down from 100, 90, 80, 70, and into the 60s by the end of next year, 2024. These are helping to drive down the total automotive cost of sales percentage. And then if you throw out the regulatory credits, here's how much the cost of sales is, excluding regulatory credits. So as time goes by, these numbers get more and more favorable, and that helps contribute to Tesla's earnings. But if you're interested in seeing what they are for each Tesla product, you'd have to have a really big screen to view this on. But for those of you who are viewing this on a 4K display or any high-definition display, you'll be able to make out these numbers. If you're watching this on your phone, I'm sorry, but that's the end of this video. So I will check back in with Loki and say, if you've enjoyed today's video, don't forget to leave me a like. Thank you to everyone who supports me. Please only support me if you can afford to. If you can't afford to support me, don't do that. But for those of you who have done well with your savings and can afford $3 a month to subscribe to me on X, I would appreciate if you do and support my efforts. That means a lot. And a special thank you to my executive producers, Kathy Kitchler and Rebellionaire.com, and I'll see you in the next one.